You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Now I'd like to introduce the representative from IMC who's going to bring out our panel. Paul Giganti is Managing Director of Business Development and Market Structure at IMC Trading. Please welcome Paul to the stage.
Thank you, everyone. Thanks for sticking around for these last two panels. This is a great way to finish out the week. I would like to introduce David Cross from Dash, and he's going to walk you through exploring global opportunities.
All right. Thanks for everybody for joining us. Super excited to be here today to talk about the global derivatives market with some esteemed panelists. First, I'd like to start off and say thanks to Trish and the entire team at OCC for putting a great conference together and giving us the opportunity to commence with our colleagues and participants within the market space. That's great. And second, I'd like to thank our panelists that are going to join us here today to provide their insight. Each one of our panelists here today provide key critical input into the global derivatives perspective, whether it's from a clearing and balance sheet perspective, a liquidity provisioning perspective, representing the institutional and retail space, and also the exchanges. So without any further ado, I'd like to introduce my panelists. Please introduce yourselves and let everybody know in the audience what it is that you spend your time doing each and every day.
Sure. Lauren Arbid, ABN AMRO Clearing. We are a bank-owned, agency-only broker-dealer, FCM, and most recently, FIC clearing member. Our core clientele is the professional trading group, the PTGs. We assist our entire portfolio of clients, whether that be the prime hedge fund sector, corporate hedgers, PTGs, retail aggregators, access 90 international marketplaces. And my role within that ecosystem is the U.S. Head of Relationship Management. Excited to speak with you. Thank you for letting me sit with you. And thanks to OIC and OCC and the sponsors for having us today.
Beautiful. My name is Mathieu Boivin-Carrier. I'm the Director of All Options USA. All Options is a market maker on equity options. We are very active in Europe. We just expanded about a year ago to the US, so I think from this panel perspective, I can talk about how was this experience and how the US market compares to Europe. And thank you, David, for the invite. I'm very looking forward for the discussion today.
My name is James Putra. I work for a company called TradeStation. We're an online broker-dealer focused on selling U.S. markets to retail and institutional customers in the U.S. and internationally. I spend most of my day nerding out on trading technology and markets. My job is to figure out where the interest is and how do we build towards that interest with our technology stack.
Okay. Randolf. I'm at the executive board of Eurex. Eurex is the biggest European derivative exchange with also very active options ground.
Great. Well, thanks everybody. And as you can see, we have a great group of panelists that can provide global insight into the global derivatives market. I guess before we get started, I'll just share a little insight and perspective. I've been in the derivative space for close to 20 years now. I'm somewhat dating myself. And I'd say over the last several years, have spent more and more time overseas and talking with market participants, whether it's in the prop trading, market making space, the technology firms, the exchanges and whatnot, and really kind of initially started to kind of seek to expand our firm's footprint on the technology side. And one of the things that we spent an awful lot of time with different participants globally, and kind of really understood what some of the major differences Obviously we're from the U.S. listed options markets to whether it's Europe, Asia, and whatnot. And I think what we kind of took away and learned is that there's tremendous opportunity globally. And what we've seen is there's been a tremendous amount of flow that's flowing into the U.S. listed options markets from Europe, from Asia, and from the Far East for a variety of different reasons. And so I think it's really important to understand what are some of the differences, whether it's market structure, regulation, all these types of things, to understand how we can collectively grow the global derivatives market, across the entire globe. So, I think to kind of segue into some of the content in discussion, I think it's really important to kind of start off and understand what are some of the structural differences. I mentioned market structure, regulation, liquidity provisioning. There's a lot of differences, right, that I think we can kind of take from different markets and look to adopt different kind of principles to grow the global derivatives market. So I guess just to kind of start and kick things off, let's talk about what some of those differences are and how that impacts each of you and your firms on a daily basis. Discussing, again, the major differences between the U.S. listed options market and the global derivatives market. Got a member from Eurex, so you're going to provide some great insight. I guess, Mathieu, I'll start off and kick it to you. You mentioned that, your firm is a international European prop trading market making firm. You've recently prioritized bringing a team of people to the United States to spend more time in the U.S. derivatives markets. Share it from your perspective. You've traded both globally and also in the U.S. What are the major differences from your perspective?
So there's a lot, I won't lie, a lot, but just for the sake of this panel and make it as concise as possible, I'm just going to highlight a few here, and mostly from a trading perspective, because that's what I'm familiar with. So in Europe, last time I checked, about 60% of the flow goes actually off screen. So most of the flow will go to broker trades, will go to wholesale business. Is not available to the screen, which makes it very hard for market makers to come and get a footprint and to access this flow. So you need to invest a lot of resources to be able to get to the core of the flow in Europe. However, what Europe has done quite great when it comes to the flow that goes to the screen, every market maker is actually created equal. So they don't have PFOF. There's no specialist schemes like we see in the US, and they make sure that even the speed doesn't matter, with what Eurex has brought up in the 5 years ago, speed bumps, which makes it so every market maker can actually compete on price and not on other things. While if I compare it to the US, what the US have done a great job at is bringing all the flow on screen, which is fantastic. Like you can just come, you plug your wires, you start trading on screen, and then you can get a portion of the pie. The problem we faced when we first got into the US is that, sure, we can access the flow on screen, but I'm always at the disadvantage when I trade, because the older firms have some perks I don't have access to. There's the PFOF and directed flow. There's the specialist scheme that the exchange put forward, which even if I'm the best at pricing, I cannot access this flow, which for us has been very tricky to deal with.
As you guys have grown your footprint, what are some of the things that, some of the differences in terms of challenges in getting people, getting the technology stacks? Are there some similarities that you've seen from expanding your footprint in the first, call it, phase of your growth phase? I know you're kind of market making on a family of exchanges, but are there any I'd say things that you're able to leverage from your European market making footprints?
Yeah, absolutely. I mean, it's a lot easier because we have the money. Obviously, we have a big bank account, which always makes it easier. Yeah, indeed. And we can also leverage the talent. At least for the support talent, we use a lot of people from Amsterdam to always supervised by people here, obviously, but that has helped us to speed our growth a lot. And if I was a new firm completely with an empty bank account, I don't think I could have expanded to the US because the costs are tremendous. You need to colo in the exchange to be able to compete at all as a market maker, and this can be very, very expensive very quickly.
Yeah, so significant barriers to entry for sure.
Yeah.
I guess, Lauren, we just talked about the liquidity provisioning and whatnot. let's kind of look at some of the differences from a clearing perspective. You guys obviously have a global clearing and banking footprint, dealing with a lot of European clients and also a lot of US-based clients. From your seat, what are some of the biggest differences from your European clients on the global derivative side versus the US counterparts that you service?
Yeah, so I think you hit it a little bit. It is hard, the barrier to entry. We have very big incumbents here. Obviously, we see big European names in the US markets and having a big footprint, but at the same time, they've been in there for a very long time. One of the fundamentals that I think from an education standpoint, we forget to say is that derivatives in Europe are all derivatives. So that's the futures and the equity options as well. That's one of the key differences when you're coming into the US derivatives market, specifically equity options. They're two different regimes in terms of regulation, and I think sometimes that's overlooked from people. But the shift that we are seeing is firms being established in Europe, in Asia Pacific, coming into the US, and how do they become a US regulated broker-dealer? What does that mean? Particularly with the change right now with the SEC in terms of, is a BD Lite available any longer, or will you have to be a full-fledged FINRA broker-dealer is certainly something there that we see.
So you mentioned the regulation piece. Is that one of the big differences that you see with a lot of your European clients? Obviously significant regulatory differences versus the US. Is that something that you guys see as a struggle that as firms move from Europe, Asia, whatnot, to a larger US presence, that they have to deal with that in a substantial way?
Yeah, I think it's fundamentally different in terms of we have, say what you want about SEC and having a heavy hand, but we have one SEC, we have one CFTC. When you look at the central securities depositories, the CSDs, you have 22, I believe, in Europe alone, and there's only 20 countries that use the euro. So just navigating some of the nationalism within there and some of the nuances of some of those specialists, I think, is a difference.
Yeah, no, that's interesting. I guess we talked a little bit about the institutional space. Obviously, in the U.S., the retail participation drives a significant percentage of the liquidity in the markets today. There's been a substantial adoption and a whole new entrant into the marketplace in the last 5 years of the retail space. I guess James, give us your perspective from the retail lens. Like, what are some of the biggest differences that you see? And from the European clients that you guys deal with today, or that you're talking to potentially, versus the U.S. retail community?
I'd say people like to trade what they're familiar with. That's the most common thing we notice wherever you go to. So it usually starts with experience in the local markets, and then however they learn to trade those local markets, they're looking. Usually when they look outside of their local jurisdictions, they're trying to go with what's familiar with them. So they either want to trade US options. They're going to try to find platforms that are familiar to them, tools that they're familiar with. And not a lot, well, it's growing now, but it used to be that you have to use the domestic US products to be able to trade your securities. Now there's a big growing business in third-party platforms. So you can use a tool or a platform that you're familiar with, maybe it's TradingView, maybe it's Optus Alpha or another localized tool, and plug it into a US broker-dealer and be able to access markets through something that you're familiar with. So that's been a big help in growing the customer base. The challenges that we face are we sell US markets internationally. So I have to set up we just set up a Dutch office, and I have to have Dutch licensed people that are also licensed in the US markets to be able to sell the US markets there. So there's challenges in trying to manage the jurisdictions, and then there's challenges in trying to manage the different language localizations in the areas where we're currently active.
Got it. So some of that friction is being eliminated, but you still see certain regulatory or jurisdiction related things that still present differences and challenges. But it is nice to hear that from the retail community that some of that friction sounds like it's being eliminated.
It's getting smoother for the customer, at least on the customer experience side. The operator side is still a little bit challenging, but making it easy for the customers is getting there. Money transfers are really painful, though. Having the ability to, as a customer, deposit funds into a U.S. broker-dealer is really tough.
Yeah. Of the clients that you guys see on the retail space that have a big footprint and daily activity in the U.S. listed market, are you seeing like that client base domestically here start to really look at expanding their footprint and options and derivatives on like Eurex as an example? Like are you starting to see that expansion?
We don't get a lot of interest on our customer base to look overseas. We do have a lot coming into the U.S. side. Our parent company is Monex out of Japan, and they have a huge interest in trading U.S. markets, largely because Japanese markets haven't done a lot in the last 20 years. It's changing a little bit, but that's a big flow of activity for us.
Got it. I think, Randolph, maybe you can share some insight, from your perspective. Obviously, there's, differences in terms of liquidity provisioning. There's difference in terms of clearinghouses. There's difference in terms of, market structure and fungibility. I guess from your perspective, in being, you're representing Eurex, what are some of the biggest things that you see from not just your exchange, but your European, derivatives markets from what we're dealing with day in, day out in the U.S.?
For me, there's lots of differences, but for me, the biggest driver has to do that the US is the most advanced capital market in the world by far. And the market cap in equity markets is much bigger. It attracts European companies like Novo Nordisk and so on here. The individual investors' engagement in the equity market, in Germany after the Corona growth is at 16% or so, and a fraction of those would go into options. And many of those go only in warrants and not in options. So you have sophisticated retail, but it's a very small amount of people. And here in the US, for me, this the high retail participation is really sort of creating a virtuous circle. Retail participation rewards market makers, stipulates that they become tighter. Institutional investors like the liquidity they enter, international investors like the liquidity, and it creates an environment where some options are almost traded like futures, even though despite the fact. And that's, for me, the major difference. And that drives in lots of other changes, how many products are available, strikes, and so on. But that's the biggest driver in difference for many other changes between Europe and US market structure.
Got it. Now, again, I think you guys all get a sense that, the global ecosystem, how important it is, but also what some of these structural differences are. And I think everybody on the stage here provides a unique insight. So I think it's been, that's extremely helpful. And then, as you start to transition, now we understand what some of these structural differences are between, the U.S., derivatives markets and the global markets, what those differences are, what those similarities are. Now it's like, okay, well, who are these participants, in the marketplace that are trading options outside of North America, whether it's in Europe, you mentioned Asia, whatnot. What are the types of firms? Obviously, in the States, we know there's institutional players. We know that the retail community has grown a tremendous amount. But of the U.S. flow that's coming into the United States, what are the types of firms? What are the types of trading strategies that you guys are collectively seeing from the seats and the lenses that you see, that are being implemented day in, day out? I guess. Lauren, maybe we'll start with you. You guys, provide, clearing services globally. What are some of the things that you guys are seeing from your client base?
Yeah, so I mentioned it previously, but we're seeing firms that have been very successful in their local regions, looking at the Super Bowl that's happening in options and volume globally, but can't take their eyes off of Taylor Swift and what's happening at that halftime show or the Eras Tour. So something's working there. It has to be. You have to be in the U.S. and those options. If you put collateral there, it's going to be deployed and you're going to get a good return on it. So what we're seeing is firms that say, hey, we're really good at making markets locally, we're trading options, but we really want to take it to that next level, and we think that we can put a dent and capture some of that market share in the market making space. And how do you become a U.S. options market maker? Well, you have to be a broker dealer, getting into that range. And so we're seeing them set up shop locally, moving into Austin or Miami or the next wonderful hotspot, whether that be in Denver in the Colorado area. So that's what we're seeing. I think that's the biggest.
No, it's interesting.
Shift, yeah.
And Mathieu, obviously, from a market making standpoint, you guys have made markets overseas. Now you're making markets here in the U.S. on a subset of exchanges. What are you guys spending your time on right now in terms of strategies that you guys are implementing, and what is on the horizon for you guys as you look to expand your footprint in the U.S. listed space?
Well, yes. We always focus on screen. That's always what we always wanted to focus, and that's one of the main reasons why we actually moved away from Europe because we couldn't access all the flow we wanted. So for us, the US was always fantastic. That's why we moved here, and that's what we're going to focus on. It's to trade on screen and to do as many products and provide liquidity as much as we can. After I've moved here, I've been here for a year now, I've discovered a certain aspect of the market structure where I realized I need to focus on, even though it was not my plan initially. So now I need to think a lot more about how I can access a PFOF flow, for example, which I never thought about before, how I'm going to be a specialist on some exchanges. So a lot of my time right now, I would much rather focus on improving prices for retail clients or for everybody in the market, actually. But I need to focus on this other side of the business, which is attracting flow that other market makers already have, basically.
So obviously taking a lot of the strategies that have made you guys successful, you're after, as you mentioned, spending a year here, is it finding new ways to interact with more flow? Is it taking advantage of certain types of market structure, certain types of technology that maybe you guys were not as aware of? Like, are there certain things that you see that are going to force you to change the way that you guys interact with the marketplace?
Absolutely, yes, absolutely. So when we first came in the US, we were thinking of being on all exchanges, and then as time went forward and we were getting experience in the market, we saw that, okay, if you don't throw tens of millions of dollars, you cannot really be on price time exchanges because you're going to get picked off by other market maker if you want to give tight prices. So it's like, okay, well, we cannot do that anymore. So decided, okay, now we're going to do pro rata instead. So there's a lot of dynamics in the US which we're not aware of. I wouldn't say anti-competitive behavior that we see in the market, but there's some favoritism, I would say, that some market makers have advantages that newcomers like us cannot take advantage of.
Got it. And then on the retail side, you mentioned that you have a lot of retail clients that have, whether it's in London or I think you mentioned Hong Kong. Like, what types of firms are they? Are they affiliated with large, existing retail trading firms? And what does the common strategy look like? Is it vanilla types of strategies? Are you seeing these retail clients overseas that are sending more flow to the U.S. start to expand in terms of their trading strategies, whether it's simple covered call type stuff or starting to trade complex orders, call spreads, put spreads, whatnot?
It's an interesting question. We tend to get a lot of entity accounts, so in smaller institutions, broker-dealers, as well as retails that come to us. That's because we're pretty friendly for international companies to open up. We're still small enough where we'll talk to you and figure out how to navigate you. Some of the larger firms have a harder time to really create bespoke solutions for various customers. But let's say by and large, what we look at in the US, you get a lot of single leg directional trades, a lot of folks that are using options as a proxy to day trade stocks. On the shorter dated ones, the shorter dated strikes. Internationally, what we're seeing is customers that are trading more sophisticated strategies, more complex option strategies. When we dig into why that is, a lot of times what we're finding is when you are focused on your local markets, you're developing your trading skills, and then you get sophisticated enough or enough capital that you're looking to diversify and expand out. So you already have a different mindset than a startup brand new account. And so you're trading things like hedging your portfolio, you're splitting your risk across multiple markets. You tend to do things that a more experienced trader would do. And we get more of those folks from the European markets, the Asia Pacific markets. I think it's largely why a lot of the broker dealers are trying to expand into these areas, because the folks that are compelled to trade the US markets tend to be on the more experienced and sophisticated side. Got it.
You mentioned kind of the evolution and adoption of some of those retail clients. I think on some of the previous panels, obviously there was great insight. Talking an awful lot about education and what that looks like here in the U.S. with a lot of large existing retail firms. Is that something that you guys are actively involved with? Not just your U.S. clients. I'm sure that's a very active focus for you. But what does that look like outside the U.S. for called an international retail type of client?
On the education side?
Yeah.
Content education is massive for us. It's a great way and a very important way for us to interact with the client base. We have some responsibilities to provide basic fundamental information so the customers can understand what they're doing, but we have a vested interest in helping them be successful. And there's limits to what we can do and recommend, but we can definitely provide the knowledge base to help people level up their skill sets and expand beyond simple trading strategies. So those single leg directional options trades that are proxies for day trading tend to be more risky for us because they tend to be people taking leveraged directional bets, and getting those folks to expand into maybe hedging a portfolio or doing spreads. Those types of customers last longer, and so if you can get them into the right types of products and tools, then they will have usually a longer longevity.
Yeah.
And doesn't matter whether it's domestic or international.
Yeah, I think that's probably a universal thing that everybody would agree upon. In terms of, obviously we talked about the differences. Now we're talking about who are some of these participants, but I guess let's now talk a little bit about why has there been more activity, more adoption from clients outside the U.S. I think we look at these numbers on a fairly routine basis. I think it's probably potentially 10 to 15% of the U.S. listed volume is coming from outside the U.S. Like from your guys' perspective, what do you see some of the reasons for this? Is it again, we've talked about some of these things, but is it market structure differences? Is it the different product selection? We obviously have a wide variety of products, a wide variety of expiries, which has been debated quite a bit with the number of expiries and strikes, and clearly that's led to more volume. But in terms of the global participation, from your guys' seats, what are some of the biggest drivers on why we're seeing more of that European participation? I guess, is it the expansion of more trading hours, as CBOE as an example has launched the global trading complex, where now the time friction is a little bit less. I guess maybe Lauren, we'll start with you in terms of some of the biggest reasons that you're seeing.
Sure, FOMO, that's one of them. Everything's rocking and rolling here. There's a ton of optionality, whether that be, as you mentioned, Dave, the amount of products you can have. I think if you follow the IPO market, where are companies looking, like what markets are they looking at to generate the next capital? There are more IPOs happening in the US than anywhere else because they know that it's deep right now and that people will go there, and then very quickly thereafter options can be launched provided the criteria, and I think Megan was speaking to some of that earlier at this conference. I think that's the biggest thing that we're seeing.
Randolf, you talked about some of the different regulatory challenges in multiple countries. We all have regulatory challenges. I guess maybe from your perspective, do you feel that is a big part of why you might see some of your clients in your local countries and regions, aside from the liquidity profile and FOMO, as we've mentioned? Do you think there's certain regulatory arbitrage that also has an impact on that?
Yes, I mean there is. For me, on the one point is obviously, as I said, if you look at the product users, starting with the equity users, and you go to derivatives, then in Europe mainly then warrants and so on, and the people who then sort of go all the way and smart enough to go to listed derivative exchanges, then it's a small step. If you've gone all this way, then to also trade, Tesla and Facebook and so on. The brand names are obviously thing. The policy and regulatory environment, obviously, in Europe is difficult for derivatives trading in general, which has a lot to do with that only so few people do it. The politicians are elected to represent the opinions of their constituency. So if you have like 300,000 people in Germany being sophisticated enough to trade derivatives on exchanges, well, you're not winning a lot of voting with this. And then you also need to consider, in Europe, the regulation is done on the EU level, one country, one vote. Most of the countries don't have any derivatives business. So it's sort of, at best, they're neutral. Maybe they have an opinion that this is gambling, or they take it as a political bargaining chip. And then, so there's relatively little upside sort of from that point. And I mean, to give you three concrete examples, in Germany we have a regulation when you trade derivatives on exchange, only on exchange. If you trade warrants, it doesn't apply. Your maximum loss you can claim for tax is 20,000 euro per year. So if you have a put spread strategy or call spread strategy, and you win on throughout the year 120,000 euro, and you lose 100,000, or your profit is 20,000 euro, the German taxman will say, well, you have actually a taxable win of 100,000 euro because the maximum amount of loss you can claim is 20,000. Or we have regulation now in Europe where brokers are not allowed to go beyond the initial margin call, sort of, if markets to protect retailers. So if markets, let's say you have a 5% initial margin call and the market goes down 7%, then the broker needs to swallow this difference. So you're not allowed as a retail broker to go after the client. And then, fortunately, the retail brokers manage that. And then another element, with respect to market making, when MiFID was done in Europe, this was around the time of the flash crash in 2010, then they identified market making is important for the efficiency of European markets, and we need to regulate it. And so they invented sort of regulatory market making as a scheme, and then because they need to regulate it, it means, well, people who do fulfill regulatory market making need to be based in the EU. So effectively, you exclude all major financial centers from market making, except for that people find ways, to do it by, not being a regulatory market maker, but do sort of market making. But this is, a waste of our time and also of participants' time, to find these things to own. So overall, it's difficult because there's not a strong market history. I mean, the Netherlands is obviously the market where it's the biggest attitude, but all other European countries are pretty small in derivatives, and that reflects in regulation.
That's where we found our home.
That's a great point. You talk about some of the different countries and taxes and regulation. It's a lot to look at country by country, but I would say that in terms of a lot of the European countries, I think we've all probably seen the growth of the derivatives market in Amsterdam substantially. I mean, Mathieu, from your perspective, you spent a lot of time there, obviously. What is it about that particular region, that particular country, that you feel like there's derivatives are accepted, adopted, embraced? What do you see about that country specifically?
Yeah, I mean, derivatives industry in Amsterdam has been around for ages. I think just the history of Amsterdam has already helped to foster the growth there, for sure. But furthermore than that, I mean, just the school, or it's very easy to attract talent as well in Amsterdam because it's been growing into this kind of crazy trading hub since probably the 1200s or something. So it's a community that's been there. So if you want to open a trading desk anywhere in Europe, in the option industry, you go to Amsterdam. And it will continue to be like that. I think especially since Brexit, where a lot of people were in London, they all relocated to Amsterdam, and some people to France, but those are weird. I want to piggyback a bit on what Randolf have said. I think a lot, the reason why the European market has not followed the US market a lot is basically because, indeed, there's so many countries in Europe, and it's so hard for anybody in the US to actually move to Europe because you need to make sense of all the different rules, all the different regulation, all the different laws, all the different exchanges, all the different clearing houses. And then I'll give you an example. You can trade the same exact option on two different exchanges, and they won't net with each other because they use different clearing houses. This is crazy. And then even more than that, you're going to have a corporate action. And then they're going to be treated differently for some reason. So it becomes super tricky. And I think it's a problem that the EU should address quickly if they want to see some kind of growth in the future.
Yeah, you kind of shifted into one of the next topics in terms of, why have we, I think we've talked about a lot of the reasons, but highlighting why we've seen some of the European and Asian markets lag the U.S. markets in terms of growth a little bit. I'd say in the last couple of years, you guys are starting to hit on that a little bit. Regulation, market structure, a number of different things. Randolf, I know you're talking recently. I've read some of the things that Eurex is doing, looking at some of the things that have been successful in the U.S., whether it's new products or shorter duration expiries. You guys are explain to us some of the things that are being done to expand growth on Eurex as an example.
Yes, I mean we are very active in these kind of things. So we have we have the oral zero-day options since August. It's a growth factor, obviously. We need to consider, however, we don't, in our market structure, we assume we probably get 10% market share in terms of option market share. I guess here it's more 50%. Another growth driver for Eurex has been, also this year, but also many years, has been dividend products. It's interesting, because 15 years ago, Eurex has moved the OTC market for dividend products on exchange, and 15 years later, we are globally sort of having 90% market share because it's seems to be a European thing, dividend derivatives. We trade more than 100,000 contracts a day. So that's a growth area. Volatility, we have the V stocks is picking up. If you look at the overall European structure, it's sort of a bit interesting. I don't know how many of you know, when you look at single equity futures, the two most active marketplaces are actually at the edge of Europe. So it's Borsa Istanbul and then the Russian exchange. It's a sort of I think they trade mainly single stock futures, not options, and as a replacement for equities. But then, outside this, for the rest of Europe, I guess Eurex is sort of the dominant exchange, for trading more single equity options than the other exchanges combined, and having also TRFs, dividends, and index positions as well. But
you guys are doing a number of things to look to expand the opportunities. But I do think one thing that has helped propel the U.S. markets, obviously, technology, a whole nother segment of the marketplace, the retail community that's come in. It sounds like that has not necessarily followed through, the retail aspect of it, in Europe, in Asia. I guess. James, maybe talk about why you think there's been a lack of retail participation, specifically in Europe, versus what we've seen here in the U.S. Listed options market, where we have seen significant adoption by the retail community.
So we see the European customers versus U.S. customers trading in U.S. markets. There is definitely a lag in the adoption of the products, but there's a lot of overlap. So for us, it's SPY and QQQ. Those are the options products, probably universally the most traded. And then we have high vol products like Tesla and NVIDIA. And those are the core ones for both the US and European traders that are trading US markets. We haven't seen the pace of zero DTE option growth, those short dated options in Europe. We think it's largely because of the more sophistication of the customer base that we're bringing over to us. What we are looking at, so we see three main opportunities generally for the retail market. One, the last 15, 20 years, CFDs have massively exploded. That's starting to be brought back into check now, and it's going to drive that capital and that interest somewhere else.
And when you say it's being brought back into check, is that because of regulation or other larger opportunities? What do you...
Starting to become less favorable from the regulators. So we're starting to have a little bit of a tightening on the regulation policy. Whether it's fully regulated out, unclear, but it's helping to bring some capital and interest into other markets. CFDs and Forex internationally is pretty big. Bringing that capital into options products will probably bring things more like these short-dated options as opposed to trading on CFDs and FX. The other two things that we look at, kind of our playbook, is we look for jurisdictions that are loosening up their regulations from a financial perspective, because typically that's so that they can draw capital into their markets, but at the same time it allows that capital to also trade other markets. And so we're seeing a lot of opportunity in various jurisdictions that are starting to liberalize that financial policy, and those markets are starting to open up to US markets. And the third are high-tech jurisdictions. so APAC, where you have companies that have benefited largely from this massive run-up in tech, and you've got a lot of wealth that's accumulated there and sophistication. So they're starting to look outside of their domestic markets to where else they can play and position. And that's been really sort of our three areas where we're looking to find opportunity.
In some of those areas of expansion, where are some of the countries that you're seeing like that capital flow into? Is it, obviously there's unfortunately global wars and whatnot that are going on, and there's migration and people to certain regions. Capital controls that you've mentioned. Are there specific countries that you guys are seeing? I'd say a more rapid evolution of adoption.
GCC and APAC, those are the two bigger areas that we're getting a lot of benefit from. India has also been quite interesting for us as it is starting to more and more open up. It's not fully there, but there is interest and flow coming out of India into the US. For me, on the retail side, very telling that TradingView, one of the largest retail platforms on the planet, decided to launch Indian options first. They thought that was the right customer base to go after prior to opening up US options markets. So there is a lot of interest and opportunity there. They're going to put these folks on a platform that opens them up to all markets, and then they're going to introduce them to US options through that trading tool.
Yeah. I guess, Mathieu, now that you guys have a footprint in the US, obviously still a large operation in Amsterdam, how are you guys prioritizing opportunities now that you have people that are local? Obviously, the time is obviously a big thing that you're able to invest more time being present in the U.S. markets. You've been here for a year with the firm. How are you guys kind of prioritizing technology, spend, effort, and resources between the two markets today?
Yeah. Well, if I'm being totally honest, I think the European market is stagnated. It's been quite boring for a while, in my opinion. So most of our resources is going full on towards the US. Up until if Europe would decide to put more flow on screen, then we might change our way of thinking. But as of right now, since we don't see any growth path anymore in EU when it comes to equity options, we are forced to just put every resources in the US. Good for us that the US is a huge market, so it's going to take a while before we have a big footprint here. So that's good. So yeah, everything is going towards the US. When we're done with this expansion, we're already thinking of what we're going to do next. It looks like there's a lot of cool things happening in Brazil, a lot of cool things happening in India. But as of right now, for the coming years, we're going to be fully focused on US. Yes.
Got it. I think that we're all hearing tremendous opportunities, not just in the US but also overseas, globally. So I think to the extent that the global market continues to grow, whether it's flow coming into the U.S. from overseas, or flow leaving the United States and going into Eurex and other global derivatives exchanges, I think it's a positive thing for the continued growth of the entire derivatives ecosystem. Again, to highlight a lot of the positive things, because I think this entire room and this entire industry has done an awful lot to foster that growth. In this particular business. That being said, I think there are always things that concern all of us, and regulation is obviously a part of that. There's a number of operational related things that are going on within the industry. I guess, what are some of the things that you guys are actively concerned about that you feel like we need to be very cognizant of to not stifle this growth in the global derivatives ecosystem? That you guys are, maybe keeps you up at night, or that gives you a little heartburn? I guess, Lauren, maybe I'll go ahead.
I can go that one. We in the U.S. are riding this massive wave that we've created for derivatives markets. The number one request I get overseas is longer trading hours. It's very convenient for us to trade 8 to 5 Monday through Friday. It is not competitive in the long term. We have to find a way to expand the global hours.
So we started. It's a good point. I'm glad you brought that up, because I feel like the extended trading hours definitely helped start that. So now you could trade U.S. listed options not just during the core session from 9:30 Eastern to 4:15. Obviously, there's now additional sessions to trade certain types of products.
I think it's like 3 index products.
Correct. So how far do we need to expand that? Is it the hours? Is it the list of available products? What do you see as the most important factors in that regard?
It's both. Largely to get the international customers over. There is also a large population in the US that grew up investing in markets like crypto markets, off exchanges that trade 24/7. They're not going to be interested to come and trade 5x7. They're going to be looking for products that trade more 24/7 markets.
Sure. I happen to agree with you. We as a technology provider, we have to worry about these types of things, providing constant support to our clients. It takes an awful lot to have a tech stack that's up 24/5, or in some cases 24/7. But Lauren, from your perspective as a global clearing firm, does that give you serious heartburn? What do you think about that?
It does. I think some of it is collateral management. I think the reason why we're moving to a shortened settlement cycle and we didn't go from T+5 to T+3 to T+0 instantaneously is because how does money move? How do we snap what a trade date is? And I think in the digital asset space, that's okay. I think when you get into more traditional finance, at what point are you saying that this is a hedge, in your position, and at what point are you cutting that off? We do see the adoption of retail aggregators that are starting in Europe. Again, it's a smaller country. The sentiment and the attitude and the attention towards capital markets is not the same as it is in the US. They don't have to think about how are they going to retire comfortably, how are they going to retire in the way that they want, like we do here in capital markets. So I think the firms that are going for the retail aggregators and saying, hey, we're going to provide you this education is going to get more and more people. That's going to continue with the overnight trading hours. I think the last thing that gives me a little heartburn right now, I'm a pretty positive person, so I'm not going to say it keeps me up at night, is the shortened settlement cycle with the U.S. as the lead going to T+1. It's happening later this month. North America, I should say, is doing that. Europe is not yet. And I think that what you're going to find is there's going to be arbitrage, there's going to be opportunities for operational error between those that are doing international trading. And Esma just said the first report came out in March. They're not going to give their final assessment to the regulatory bodies and recommendations until I think the deadline's January 2025. We all know how slow that'll go between an implementation phase. So I think that that's going to continue for longer than what any of us probably would have liked to have seen, just thinking operationally how you overcome that.
Yeah, I think any time the industry grows as it has in the last several years, there's operational challenges, there's technology challenges, there's regulatory things that we all have to deal with. I'd like to focus on the positives. I think we've all done a great job fostering the growth in the global derivatives market. I see we're running out of time, so we're going to table it for now. But I'd like to thank all of our panelists here. You guys have provided great insight into what you see in the global derivative space, and you're also helping foster that growth going forward. So I'd like to thank all of you and everybody for giving us the time here this morning. So thank you.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.